Welcome to Annuity News Now. The opportunity for retirement income products continues to expand as the age segments to which retirement income products can be marketed are broadening. That's according to a new research report. It's called Cracking the Code to Retirement Income: Key Developments and Opportunities, released by Financial Research Corporation. My guest first is the author of the report, Leslie Prescott. Leslie, it's a pleasure. Thanks for joining us.
Thanks for having me.
And we have FRC Vice President and Retirement Income Practice Leader, Matt Schott. Matt, thanks for joining us.
Great to be here, Scott.
Who wants to take the first question? What does FRC do?
Well, let me field that, Scott.
Okay.
Again, this is Matt Schott. FRC's been in business for approximately 20 years. And one of the core aspects of what we do is data, particularly around trying to track what are people buying in terms of asset management products. Mm-hmm. So we track asset levels and sales flows on a variety of products, including mutual funds, ETFs, variable annuities. Mm-hmm. Secondly, we provide insights, methodologies, and frameworks for understanding how and why consumers buy what they buy. Mm-hmm. And then also from the advisor perspective, kind of what, why, and how advisors and the firms that employ them mm-hmm. Are selling.
Okay.
So around these two kind of value propositions, we deliver value through proprietary and custom research, mm-hmm. Through monthly and quarterly publications, mm-hmm. And then also consulting. And really our focus is on helping inform firms around their product development and sales and marketing. So that in a nutshell is what we do at FRC.
Okay. Well, Leslie, the predominant news that we hear about retirees is that the baby boomers, there's so many retirees out there. People are beginning, obviously they're living longer. They're starting to stay in the workforce longer, primarily because not only are they living longer, but they don't seem to be properly funded for retirement. How does all this change the landscape and the way products really need to be designed now?
Well, the baby boomers certainly are a driving force out there, and many firms, many advisors, have seen the demographics and the assets that these folks hold and are looking for ways to tap into that market. But, of course, everybody needs to remember that every individual is different, and the profile of baby boomers and current retirees is as individual as their personalities. Within that, of course, there are some interesting trends that we have uncovered by taking a deep look at what these folks are actually buying in terms of investment and insurance products for retirement. And one of the things that we found is that there's a much wider range for buying retirement income products than perhaps is typically thought of, and we believe that age range is expanding. Mm-hmm. So on the upper end, if you take a look at how people are taking money out of their IRAs and when they are purchasing income annuities, and even when they are taking withdrawals and how many withdrawals they're taking from their variable annuity contracts, you see that, in fact, many people wait to tap their retirement assets. So, in fact, they're not drawing money from their IRAs until they need until they're 70 and a half. Mm-hmm. And many income annuities are not purchased until folks are in their 70s. Mm-hmm. So that tells us that it's not just age 65 or age 63 or whatever the retirement date is that advisors need to focus on. They should be looking well into their 70s at the retirement income needs of their clients.
Mm-hmm. So they probably have to plan for a much longer term, and I guess part of the report says that Leslie, that there's always been sort of a distinct line between the accumulation product and then just the income distribution product. But you talk about the report showing that these lines are kind of blurring a little bit. Can you talk about that?
Yeah, we are starting to see a little bit of a blurring. One of the things that I think when we think about retirement, we think about this kind of nice, smooth, you retire and then you need an income for the rest of your life. Scott, you already alluded to the fact that folks might work longer, or they might kind of semi-retire and continue to work. Maybe they're making enough money to make ends meet, but they're not saving any further for retirement. Or maybe they need, with work and a little bit of extra income, they need a bridge to when they start Social Security, or they want to delay and start Social Security later, or delay to get a pension. So they might need a product for a period of years, 5 to 10 years, that would give them a certain amount of income. But we are seeing a blurring between retirement accumulation products and retirement income products. So let me just give you one example. We're seeing some pretty good sales growth in terms of variable annuities with living withdrawal benefits. Mm-hmm. So most people would think of and generally use a variable annuity more as an accumulation vehicle. We're seeing with these products with the guaranteed living withdrawal benefits that they might be designed so that you have somewhat of a bonus or somewhat of a kicker, an extra, an increase in income if you actually purchase this product 5 to 10 years prior to retirement. So let's say if you purchased it right at retirement date, you'd get a certain amount of guaranteed withdrawal benefit. Mm-hmm. But if you purchase it 5 to 10 years before retirement date, and as your assets grow, the company may add in a kicker, and that may be in terms of an increased income base, mm-hmm. or it may be in terms of an increased percentage withdrawal benefit. So, you can kind of see where that combines accumulation, because mm-hmm. the value in your account is increasing, your income base is increasing. But it also, and the client can see an increase, a stable but increasing floor of income that's coming along with that growth of assets. Mm-hmm. So that's one example of where we're seeing that blurring. Another example might be clients tend to want to get a little bit more conservative as they move towards retirement. So if you think of target date funds, those are designed to get more conservative towards that target date, which at least when these funds came out, the idea was the target date was the date that you retire. Well, that's still the idea. The target date is the date you retire, but a lot of these now, the glide path is designed to go through retirement or to go to a date maybe 5, 10, 15 years after the target date. So they still may be a little more aggressive at the start of retirement and then get more conservative throughout the first band of retirement years. So again, you see there a little bit of a blending or blurring between a strict accumulation product and a retirement income product.
When talking about the average retiree, someone who is perhaps a retirement planner, for example, we'll talk about that distinct line. Well, now we're here, now it's time to just get the income together. And then, you have people who are looking for maybe just a little potential for some income growth in that time period as well. You're looking at the equity markets now, which seem to be sort of, I don't know how to put it, maybe a little stagnant, perhaps. Some people have even called it sort of a trader's market. How does one manage the risk here with this moderate exposure to the equity markets?
Well, I think one of the things that we think investors are going to be increasingly more demanding of advisors in terms of monitoring their portfolios. So help me understand how I can spend, and that may differ from year to year. Another thing that I think is really important to understand, I mean, you alluded to the equity market. but we're also kind of at the tail end of a 2 or 3 decade-long bull market in bonds. We're at a point in time where interest rates are pretty close, or if not at record lows. So it's a little bit of a challenge to, where do you position your assets, to drive income and to drive a high level of income. So I think it's going to be imperative on advisors and clients to work together, to monitor more. We've seen some studies as well that kind of show, if you think of maximum safe withdrawal rates, they typically say it's 4%. Well, we've seen some studies that show that can vary pretty dramatically, and it has. If you had done that analysis at various starting points over the last 30 to 40 years, you've seen some instances where the maximum safe withdrawal rate, based strictly on historical data, would have been somewhat less than 4%, and other times where it's up, maybe 7, 8, 9%. So no matter how you position your client's portfolio, it needs to be monitored, and I think advisors would do well to really try to encourage their clients to get some spending flexibility into their budget, to where they can, increase or decrease their spending or their expected spending, by 5, 10, 15% on a year-over-year basis. And that can help to go a long way to address some of the concerns around, the volatility of markets and sequence of return risk.
Yeah, let me just add something to Matt's excellent points there. I would just encourage advisors to seek out clients, prospects in their early 50s, because some of the work that needs to be done to minimize the effect of luck on your retirement happiness and the ability for your portfolio to last throughout retirement, some of that work needs to be done well before retirement, making sure that clients are less vulnerable to market ups and downs as they get closer to retirement, and perhaps even selling real estate as an example. These are things that really should be handled well in advance.
And that's I think that's an excellent point, because I think most investment strategies with regards to retirement depend on your portfolio doubling in the last decade, and as the markets look right now, that seems to be a hard thing to achieve. And then you're trying to be conservative and protect the assets that you already have. It seems like a very difficult task.
It is indeed, and I think to some extent advisors and their clients need to remember that no one can predict the markets, no one can predict interest rates, and some of these moves should be made regardless of what's going on in the market.
Scott, that was a great point. If you've invested your portfolio and you think you're going to get around 7%, you would expect whatever you have at 50 to double by 60, or in that last 10 years, you're kind of anticipating of a doubling of those assets. But one of the things that I think, provides some flexibility is you would also presume that while, by the time the client's 45 or 50, hopefully they've got a nice chunk of assets. And yes, if that asset base can double 1 or 2 more times before they retire, that's really the meat of what's going to make them successful or not. But you're also in that time frame in your late 50s and 60s when you're probably making as much or more money than you've ever made. You're probably saving at a rate that's very likely as high as you've ever saved. So I think a lot of that you can keep a portfolio the existing portfolio somewhat more aggressively invested, and use that new savings to start to lay in your more conservative tranches that you want to have and that you want to position yourself towards during retirement.
Excellent discussion. We appreciate your time. My guest, once again, author of the report, Cracking the Code to Retirement Income, Leslie Prescott. Leslie from FRC, thank you.
You're welcome.
And also FRC Vice President and Retirement Income Practice Leader, Mr. Matt Schott. Matt, thank you.
Absolutely. Thank you, Scott. Appreciate you having us.
I'm Scott Drake, and you're watching Annuity News Now.